Thanks. Yeah, seems everything is working fine. So let's start tonight's webinar. Hello everyone, welcome to tonight's Orienta Premium Education Program, Forward Thinking Trader Part 3. My name is Hao. I'm on behalf of Trade with Precision for tonight's webinar. Tonight's section is about understanding the bigger picture, Part 1 and Part 2, which was presented by my colleague Craig Kropp last 2 weeks. We already started to discuss the price action, the importance of price action. Tonight, we are still continue with this theme, adding more technical indicators into it, helping us to get a better understanding of the price action. Yeah. Before we start, there are two disclaimers. One is from Orienta, so could you please go through the disclaimer quickly for about 20 seconds. And also, if you do have any trading related questions or any questions about the content of tonight's presentation, please type in the Q&A box during my webinar, and I will answer it straight away. And also, we will have a Q&A section at the end of the webinar. And second disclaimer is from Trade with Precision, and I'm from Trade with Precision, and my name's Hao. So for those of you who don't know me, I just say an introduction of myself. And I'm one of the team members from Trade with Precision, and forgive me about my language because my first language is not English. So if any grammar difficulty during the presentation, so please maybe forgive me about that. Yeah, I'm just a trader. I just bring my experience to you. So this is why I'm here today. Okay, so before we start, just a brief introduction about Orienta. And Orienta was incorporated in 1996. It is one of the first few companies to offer fully automated online currency trading. Orienta has been in the online trading business for a long time, so we handle more than 1 million queries a day nowadays. We offer the state-of-the-art trading platform, the FX Trade platform, to all our investors, whether you are a retail investor or an institutional investor. We receive many awards around the world. Below is just one award we received in 2013. If you like, you can always go and check the Orienta's website for further information. About Trade with Precision, and also if you don't know our company, it was founded by Nick McDonald, and we're starting to educating traders since 2006. We specialize in teaching strategies like the two we are teaching during the premium course. One is the momentum breakout strategy. The second one is called the trend flow strategy. This strategy is applicable to any markets, any time frame, like the forex market especially. And the company growth via a positive word of mouth and also strong corporate relationship. We started to educating Orienta's clients from last year, 2013. The main difference between our company and other educating institution is we are, as a presenters, we are both a real life traders. We just bring our live trading experience to all our clients, helping you to make a better understanding about trading, and also helping you to get onto a real consistent profitable business from trading as well. So we are a team of global traders based on many continents and using multiple language to teach our clients. So tonight's agenda, first we are going to continue to look further into the assessment of the price action. Tonight we add two more indicators, MACD and RSI. Because at part 1 of our premium course, we discussed that the most important technical analyst tools is the price action itself, and all the indicators is only a second layer, just like the icing on the cake, to helping us to understanding the price action. So the first indicator we introduce is from part 2 about moving average, how to use the moving average. Tonight we introduce the indicators MACD and RSI. It is also helping us to continue to assess the price action from different angle, helping us to catch the strongest trend out there. So how we are going to use it? We use the concept called convergence and divergence. This is what we call also a leading indicators. What is a leading indicators? What is the difference between leading indicators and lagging indicators? We are going to discuss a little bit further when we get to that. The part 3 of tonight is multiple time frame analysis. It is so important in trading success, in my opinion, because a lot of new traders, when they started trading, they just look at one time frame, saying that, oh, I'm trading only from the 5 minutes, so I only look at the 5-minute chart. But that's a misconception. For you to get to a successful trading, multiple time frames is a key for you, because it offers a much clearer picture for the whole currency movement. If we can understand the whole picture of certain currency, we can form a better idea where the currency might go in the near future. So multiple time frame analysis is the tools to help to aiding us to doing that. And after that, after multiple time frame analysis, now and then we started to combine all the technical factors we learned during the past 3 weeks to start to form our strategy. And at last, of course, we will briefly introduce what we are going to cover in part 4 in the premium course for thinking traders, which will be on from next week, next Monday. Yeah. Okay. Part 1: indicators, convergence and divergence. Price momentum, it is also what we call trend. Trend is one of the single most important technical tools we need to understand. So from part 1 up to part 3 today, even up to part 4, the whole course, the whole strategy, trend is still the #1 tool we need to discuss every now and then. So what is a trend? Just a quick recap. What is a trend? The trend is formed by a series of higher highs and higher lows if it changes from downtrend to uptrend. So this is a quick introduction, quick recap. When the downtrend failed to make a lower high here, it is a first sign telling us the trend may be reversing in the future. When the price took out the old high back here, the uptrend officially established at this point. After that, the price continued to make series of higher highs and higher lows. This is what we call a consistent, orderly uptrend here. During this stable period of uptrend, we may possibly find a lot of trading opportunities from this trend. And once the uptrend failed to make a new high back here, this is also the first warning sign telling us the trend may come to an end. If and only if it takes out the old low back here, then the new downtrend established at this point. But is there any other way we can tell as early as somewhere from here, even from here, that the trend is starting to get tired? So this is what we call the price momentum. We are trying to get on board of this, to get to the long side from a orderly trend somewhere at the very beginning of the trend, like here. Maybe we're trying to get long here, trying to get long here, or get long here, but definitely we're not trying not to get on board somewhere near here or here, which is close to the end of the trend. So is there a way to tell us this trend is going to maybe tiring out or maybe running out of steam? And this at that time we stop to buying the uptrend anymore. This is what we call the price momentum. Tonight we introduced this concept, convergence and divergence. This is the main purpose for us to determine when the price momentum is dying out. This is the main purpose. So how are we going to measure the price momentum? Up to today, we already know two ways to determine the trend or determine the momentum of the price. The first one is by the definition of the trend. This is simple, checking the highs and the lows from the chart. If the chart continues to make higher highs and higher lows, then the trend is still in an uptrend. And if the chart is still making lower highs and lower lows, then the trend is still in an downtrend. This is a simple definition of the trend, but this is also the most effective way to measure the trend as well. Second way we discussed last week is using the moving average. By the moving average geometry, we can tell by the first sign of the chart if the chart is still in a well-defined trend or not. Simply by looking at the moving average, are they still in order? The 4 moving average, are they still in order? 10 below 20, 20 below 50, 50 below 200. So this is what we call the moving average geometry or the structure. If they are still clear fanning to the upside or fanning to the downside, this is where we are looking for. This is also what we call the strong trend is still happening right now. Today, we are going to look at a further measurement of the momentum using indicators. These indicators telling us a much further ahead, or maybe what we call a much better warning sign of a trend may either continue or maybe already starting to running out of steam. Because when we as a trader, we're trying to get on board when the trend is still strong, but not at the end of the trend, right? So the most reliable trades tend to occur when both the trend momentum and the indicator momentums, when they are all in agreement. So it looks like a little bit complex, but when we get to charts, it's getting much more easier for you to understand. First, what indicators we are using? We use these two, MACD and RSI. The settings are both standard settings. MACD 12.26.9, RSI is 14. These are standard settings from Oyenda's platform, so we don't need to make a change of it. And also we know when we started trading, we sometimes learn some really so-called simple basic trading strategies like the moving average crossover, like the overbought oversell zone from the RSI, this kind of so-called signal for us to get long or get short. This is what we call the traditional way to use the indicator. And what I can tell you is this kind of traditional signal based on the indicator, they are all lagging indicators. What does lagging mean? What does lagging mean? It means it is when the price already moved a long way before the indicator starts to move. Just an example from the chart below. We can see moving average or MACD cross from the above zero down below zero is here, and this is the signal telling us based on the indicator, based on the MACD. This is a signal telling us to get short. But if we did get short from here, actually we are shorting on from this candle, and we can see the price already moved 1, 2, 3, 3 candles lower already. So actually we missed quite a large part of the move. The whole move is from here to here, and we get on board almost like 50% later of the whole move. So this is what we call a lagging indicators. And so even in this way, it looks like we still can make some money out of it. But think about the risk-reward ratio. This is also what we are going to discuss in the last part of today's webinar about risk management. For a trade for us to deserve to take, is we're looking for at least a minimum risk-reward ratio of 1:1. But if we get on board from here, this is our risk, and this is our potential reward. This is it's a less than less than 1:1 risk-reward ratio. So this is not the ideal position, ideal spot for us to get on to the short side. So that's why this kind of a traditional way to use the indicator is they are all lagging in a way. Why is that? The main reason is no matter how complicated the indicator is, it is based on one inevitable calculation, is the average. Average is helping us to smooth the price action. Yes, it looks much better based on the indicator because it is smooth and looking nicely floating from the top to the bottom. But the main problem is they are lagging the price action. So we can't trade from these lagging indicators. If we trade based on that, we will lose money. So if we want to be a successful trader, we want to get on board somewhere from here, or from here. This is where the start of the move. This is also what we discussed from part 1 and part 2 already. As a professional trader, we try to get on board at the beginning of the move, but not at the end of the move. Like here, this is also almost coming to the end of the move. So it is in general, telling us the traditional way to use it is a lagging indicator. It is a poor signal. And what we are going to use from these two indicators, this is all what we call convergence and divergence. We call these two these two names, convergence and divergence, leading indicators. What exactly is leading indicators? Leading indicators simply means we may get an indication. Remember, it is just an indication of a possible price action even before the price starts to move. This is exactly what we want, right? So remember, it is only a possible direction, but not certain. Remember, but it is good enough for us to telling us at least not to take some poor trade, in my opinion. Because in trading, we just need to take the best trade out there. We don't need to take every single trade from the chart. We just need to take the best out of the decks to make our bet from the chart to make a consistent profit out of the market. So leading indicators, it is the way to helping us to tell if the trend may be starting to running up, and then we just get on board anymore. So as leading indicator, we ignore the traditional way to use these two indicators like overbought, oversold, or the moving average crossover, etc. So first, looking at convergence. What exactly is convergence mean? Convergence means when the price and the indicators both are trending in a similar direction, in a similar fashion. In more simple way, it is they should be trending in the same direction. Like if the price is in an uptrend, when the price is making higher highs, the indicators should also be making higher highs, which is also in an uptrend. If the price making lower lows, the indicators also making lower lows, which is in a downtrend as well. So convergence, it is just another way telling us the trend continuation, the probability of the trend continuation. If the probability is high, then we maybe have more confidence to place the trade, right? So trading is just all about stacking probability in our favor. Convergence is just another way to telling us to add to our probability. So looking at charts, simple understanding what is bullish convergence, what is bearish convergence. Bullish convergence, it is what happening in uptrend. Remember, bullish convergence only works in uptrends. Trend making high highs, compare the highs of the trend, and then compare the same height of the same place with the indicators here. This high compare with this high, and then compare with this high. This high compare with this high of the indicator, this high with the indicators. We can see that the price action is making higher highs to trending up. The indicators also trending up, making new highs. In this situation, we call both indicators RSI and MACD, they are all converging with the price. This is also what we call bullish convergence. Remember, this is a note for you. Remember, we only compares the high in an uptrend. Remember this point. We only compare the highs in the uptrend. We don't care about the lows, okay, in an uptrend. So vice versa, in a downtrend, we compare only the lows on the downtrend, which means the price of the chart making series of lower lows, which means the lows on the chart keep pushing lower. And also the indicators also keep pushing lower. This is what we call bearish convergence. No matter bullish convergence or bearish convergence, telling us one meaning is the trend right now is still strong. So we are still confident to place the order, because the trend right now is still really strong to the upside or really strong to the downside. This is why we are looking for this convergence and divergence from the chart. Okay, so I hope you understand this one, and bullish convergence and bearish convergence. And the rules to using convergence and divergence. Number one, it is really, really important. Convergence, it is only valid in a trending market. This is what we already discussed many times, telling you many times, even from part 1 of our course. Trend is one of the most important technical tools. Only in a trending market, a lot of the other technical tools may help us to understanding the price action. If there's no trend, there's no concept of convergence. So only in trending market, the convergence working in trending markets. Looking for trades or finding trades setups when the price and indicators both converge, because that is the time the trend is still strong. So we will have more confidence when the trend is still strong. And number 3 is convergence is not only happening from one time frame. We try to look for convergence across multiple time frames. The reason is simple. If one time frame, like the 15-minute chart, trend is up, the indicators and the price both converge to the upside, which telling me the 50-minute chart is strong. If the same is happening in the 60-minute chart, it's happening in the 240-minute chart, which means both the high time frames, 240 minutes, 60 minutes, they are also still trending up nicely with strong momentum. This also adds to our probability. One simple way to understanding this one is just saying the people trading 15-minute chart looking for convergence. People trading the 60-minute chart also looking for convergence. If they are both converge and trending up nicely, this telling us this price action momentum is really strong across multiple time frames. In general, it's just adding the probability in our favor. So this is the third rule. Number 4 is only compare the highs in uptrend. and only compare the lows in downtrend. We don't need to look at the lows in uptrend, and also we don't look at the highs in the downtrend. And exactly, sometimes people may ask how precise we need to look at convergence. Do we need a ruler to measure it out, or do we need to sit and wait to watch it break? And this is also comes back to the question: trading, is it an art or is it a science? This is convergent. To me, is more like an art than science, because we just need to make sure it is getting really close to converging, but definitely not diverging. We are going to discuss divergence in a little bit later, but let us finish the convergence first. So now come to the practice. Oh, everyone, please join this practice. Multiple time frame convergence. Here, two charts. Please type your answer in the Q&A box. Left hand side of the chart, 1 hour chart. Right hand side of the chart is 2 hour chart. Both charts, are they converge on both charts? Please type in your answer in the Q&A box, please. Let me see if you get the concept of convergence and divergence correctly. Yeah, okay, well, most of you get the answer right. So, yeah, both charts are all converge to the downside, because when the price is making lower lows on the chart, making lower lows on the chart, this one is trending down, this one trending down, trending down, trending down. 2 hour chart, same, making lower lows, also indicators making lower lows here. So both charts are converged to the downside. Yep, and here is a questions coming in. For convergence, are we still use the standard settings on the MACD and RSI? Yes, correct. We don't need to change any settings from the indicator. Standard setting works fine for us. And just a reminder for you and online, we have our ON That's Call It song. It's also online. If you do have any questions about ONDA or about account opening, and please type in the Q&A box as well. And once Song see the question, he will answer it straight away from the Q&A box. Okay, so come back to the slides. Let's back to the slides. So convergence practical, another practical to telling us price MACD convergence. Are they both is the price and MACD converge on this chart and on this chart? Also, please type your answer in the Q&A box. Okay, yeah, we got some mixed answer from here. Someone say it is yes, someone say no. Okay, let's check. Price, first checking the price. Is the price in an uptrend first? This is really important. Don't straight look at the indicator. Look at the price first. The price trending up, making higher highs, making higher lows. Yes, they are making new highs of the price. Then we compare the same spot from the chart. Okay, so this is okay. I understand why people are saying no. The reason is price making new highs, the indicators pretty much flat, right? So this is acceptable to us. This is another new concept. Yes, indicator is not making new high, but it is flat, which is telling us not much information. Actually, telling us this is still a steady price action to the upside. Because we definitely do not want to see is when the price going up, the indicators going down in this way. This is what we call divergence. So this is acceptable convergence, not the optimal way of convergence, but this is an acceptable way of conversion. Indicator flat is okay, just telling us not much information we can get from the indicator, just telling us a steady price action to the upside. So optimal conversion way is when price making new highs, indicators making new highs, like this way. And the suboptimal way, or what we call the acceptable way, is this kind of situation. It is when the indicator is flat. When the price making new highs, indicator is flat. This is an acceptable way of convergence. So how are we going to use indicators? This is the first way to use indicators to look at the trend, convergence, and divergence. So let's check another practical. Convergence practicals. These two time frames, are they converge on these two time frames? MACD is still flat. It's really pretty, just like we say, we don't really need a ruler to measure exactly, oh, it is 1 millimeter below the previous low, previous high. We don't have to do that. We just need to see it by eye. What is an obvious divergence? When we're going to cover the divergence, we will see more clear. We can see obviously the price is going up, and at least the indicator is not going down. That's fine. So yeah, this is the answer. I hope I answered your question. And yeah, this is the, yeah, please type in your answer in the Q&A box as well. This chart, the 2-hour chart on the left-hand side, the 4-hour chart on the right-hand side, is the price and the indicators converge over these two time frames? Okay, let me see. Someone say converge, someone say diverge. So it looks like we still need to go into a little bit more detail, go through this convergence concept more slowly. These two charts, the answer is they are both diverge, not convergence. Simply, we compare the low on here, compare the low on the chart, bring the line down here, bring a line down here, bring a line down here, bring a line down here. So as we can see, when the price making new lows, the indicators make a new high, right? The lows is getting higher on the indicator. Same happening here. The indicator is getting higher on this chart, which telling us this is divergent, definitely not convergent. So we can tell this chart compared to the last chart, this chart is telling us it's really clear when the price making new lows, the indicator failed to make a new low, right? Instead, it's making a new high instead, like this way. This is making new high. This is also making new high. So this is telling us this is chart. These two charts both are not converged, which telling us this is the point the price is getting tired. It is not the best time for us to get on board to short the market right now. So this is telling us divergence is happening on these two charts. Okay, another question coming in. If the indicator is flat, does that imply the momentum is getting to an exhaustion point? No. When the indicator is flat, what I can tell is sometimes I use this analogy. When the indicators converge nicely, when the price is going up, indicators also going up. It is just like the when the arrow just leaving the archer. So this is the time. It's a strong price power behind the arrow, and when the indicator is flat, it's just a, or maybe we can use the plane takeoff. When the plane is taking off, or the rocket taking off, it is when the starting point, the initial phase, is where the power is the most powerful way. That's where the prices converge. During the time when the rocket or the plane is fly in a constant speed, that is time just like the indicator is going to flat. And when it started to descend, and at this time it's getting to when it's the time that it's getting exhausted, this is when the chart started to show diverge on the chart, just like the chart right now. Okay, yeah, I hope you get it clear. Make sure in uptrend we compare the highs, and in downtrend we compare the lows. Okay, so this is really important. Okay, next. So just now we discussed the first way to use converge. It is to compare the highs and the lows of the chart to the highs and the lows of the indicator to determine if the trend right now is still strong to the upside or strong to the downside. This is the first way to use convergence. Second way to use the convergence we call breakout convergence. Breakout convergence, it is an essential factor in our momentum breakout strategy, because we need to make sure what is a breakout. Actually, a breakout is the price breaking out of a flat level, so which means either the price is making a new high from the chart or making a new low from the chart. So breakout convergence is we need to make sure when the price starts to break out, the indicator also start to break out as well. So first, it looks like it's really difficult to master this concept, but as you look at the chart more often, you will know it is really easy, because the convergence, the breakout convergence, can tell before it really happens. So actually, we really do not need to sit and watch to see the breakout happens. We just telling from the indicator, and then we know if the indicator is about to do the same when the chart breaks out or not. So get to the chart is much easier to understanding this concept. So just like here, first we look at the trend every time. Look at convergence and divergence every time, no matter you are checking convergence of the trend or convergence of the breakout. Always start to check the trend first to see if the trend is a trend is present on the chart. So trend making new lower high, making new lower lows, and then the lows the highs keep pushing lower, and then the lows form a flat level, a support level is here, right? So the downtrend is still strongly bearish to the downside. So then if the price breaks out of this support level, we can tell the indicator it is also possible to break out to the new low, making a new low from the indicator as well, right? Because the level is flat here, the indicator is also flat here. This indicator is also flat here. So this, as the price started to break out, and we can tell even before the price breaks out, we can tell the indicator is also highly likely to continue to move to the lower ground as well at the same time with the price. This is what we call breakout convergence. This is the optimal optimal scenario of the breakout convergence. Second way is second scenario is also what we call the acceptable scenario. It is one indicators converge and the other indicator slightly diverge. Remember, slightly only, definitely not strong diverge. So simple, price flat level on the price, flat level on the RSI, a little bit, we can tell a little bit diverge on the MACD. So this is acceptable. So actually, these two indicators is all just cancel out with each other, which is telling us the same meaning as the flat, telling us we can get not too much information from the indicator, because one is converge, one is diverge. They both cancel out each other. So this telling us this breakout is still acceptable to us. We do not want to see both happening in this way. So this is what we call diverge. So let's finish the convergence first. So this is the second scenario, acceptable scenario. The third scenario is the one we are not accept. We don't accept this one because we can see the flat level on the chart, and also we can see if the price started to break up right now, both in the indicator will start to get diverged, because as the price started to break up to a new high, these two indicators is not going to break up to the new high. So this is before the price breaks up. We already know that. So it is not the ideal situation for us to trade the breakout right now. So this is the third scenario. So another question, at what point, for example, would you enter a short on the last chart? For example, what point? So yeah, this comes to the strategy part. Now we are still teaching the ingredient of the strategy. So we haven't touched any entry point or stop loss point at the moment. So please be more patient. We are going to discuss it with a live example, not a live example, but with much more live trading screenshots from next week, but not from this week. Okay, so this week we are still teaching the ingredient part. So this is the third scenario. We are not accepting this scenario because both indicators fail to converge when the price breaks up. So this is that. So just a recap, two ways to use convergence and divergence. First way is converge on the trend. Second way is converge on the breakout or breakdown. Now come to the diverge part. Divergence is also leading indicators. It is telling us the trend is potentially running out of steam. But this is also another important concept for you to know. The trend is maybe running out of the steam. It doesn't mean the trend reverse. Remember, this is really important. The change of trend must strictly based on the highs and the lows. Only the highs get changing from high highs and high lows into low highs and low lows. Then we call this is a change of trend. Divergence of the highs only showing us or only telling us the potential uptrend is running out of steam. It doesn't mean the uptrend is going into a downtrend. This is really, really important concept. So divergence only telling us it is not a good time for us to get to the long side anymore. So let's check what exactly is divergence means. Bullish divergence. What is bullish divergence? Simple. When the chart making new lows, the indicators of the lows is making new highs. This is what we call bullish divergence. This is happening in a downtrend. A real chart example is around the right-hand side of the slide. You can see as the price making new lows and the indicators is making new highs. This is what we call bullish divergence. Bullish divergence telling us is the potentially this chart may goes into a really a really weak downtrend. Now, possibly goes into a consolidation in the near future. So it is not the great time for us to get on short anymore. This is the only meaning telling us based on the divergence. Really, really important concept here, because a lot of new traders, especially for myself, I spend a lot of time to understand this concept. At first, a lot of new traders learning this convergence and divergence concept, saying, "Oh, this chart shows divergence. Now we are going to short right now." So this is a misconception. Divergence only telling us the current strength of the trend is weakening. This is what it's telling us. So this is what we call bullish divergence. On the other side, bearish divergence is happening on the uptrend. When the price making new highs on the chart, indicators making the highs of the indicators is making new lows, which telling us the uptrend is weakening, just like the right-hand side of the chart, it is a divergence. It is the divergence is happening on the chart right now. So this is what we call bearish divergence. This is also another optimal chart structures. Remember what we call optimal chart structures based from the part 1 of our course, of the premium course. We need to look at steady flow of the trend, no erratic price action, no unstable price action, no big candles, long tails from the chart. We need to look for moving average patterns. We need to look for a small bullish candle in the buy zone of the chart. Today, we're going to add one more concept into the optimal chart structure. It is the convergence and divergence concept. If the chart like this is the chart we look at the top. We look at from the previous 2 parts of the course until we see the MACD and RSI from the chart. The chart is still showing us an optimal chart structure. But when we check in the chart, price making new highs, the indicators making new lows. This is making our optimal chart structure a lot less attractive. So because the chart is showing us it is divergent, telling us the chart is running out of steam. So at this moment, on the right hand side of the chart, because we always look at the right hand side of the chart, this is where we look at the live chart as well. At the right hand side of the chart, telling us because of the divergence present from the chart, telling us it's not a good time to look for long trade anymore. So similar story, the optimal chart structure from a downtrend, it is the same as what we discussed in the previous 2 parts of the course. We need to look at steady flow of the trend, need to look at consistent price action, look at the moving average geometry. But if the divergence present from the chart, like here, price making new lows, indicators making new highs, telling us it is not a good time to looking for short trade opportunity anymore. So come to the practical part of the divergence. This is the chart we are looking at. Suppose this is a live chart. When the chart showing like this in this way, do we really need to watch the breakout happen to tell if the breakout is converge or diverge? Of course not. Because let's do this example. Because when the price make a new, it starts to break down, make a new low here. We compare the low, the original low is here, and draw a flat line, and we can tell when the price break. If the price starts to break down right now, the indicator is not going to break down to make a new low. And this is also happening the same on the MACD. So this is telling us the breakout is not converge, it is a diverge breakout. So it is not a good time to trade the breakout right now, because it is more often than not, it is showing us a false breakout. So how to trade getting a more possible true breakout is we look for converge of the breakout. But if the divergence of the breakout is happening, it is not the ideal scenario to trade the breakout anymore. So this is a one way to telling us, helping us to avoid this kind of false breakout as well. And this is also an essential factor in our trading strategy of the momentum breakout strategy. Okay, could you please remind me the moving average value? We use 10, 20, 50, and 200. These 4 lines: 10, 20, 50, and 200. Okay. So a little bit advanced part of the convergence and divergence concept, because what we see just now is an ideal scenario, but more often than not, when we're checking charts, we may see sometimes it converge, sometimes it diverge on the same chart. How are we going to understand this kind of scenario happening on the chart. Let's see. These two lows, price making new lows, indicators making new highs, indicators making new highs. So up to this point, suppose we are not seeing this part of the chart. Up to this point, it is divergent, right? Because telling us the indicator making new low, price making new low, indicator making new high. It is not the place for us to getting short anymore. But it doesn't mean the trend reverse. That is a general rule of thumb for you to know is if this kind of divergence happening on the chart, it is more often than not telling us a deeper pullback is happening actually from the chart. Because what is a normal pullback? Remember from the moving average part we discussed in part 2. A normal pullback is when the price move up, pulling back into the 10 and 20 period moving average, and then move down, back into 10 20, move down, back into 10 and 20, move down, back into 10 20, and then move down again. Now the chart is diverged right now. Diverge is telling us another meaning is possibly a much deeper pullback is happening, which means instead of pulling back into the 10 and 20 from the chart may pull back a little bit further up to the 50 moving average. So this is what we call, if the price does pull back to the 50 period moving average, we call this O divergence played out. If the price pulls back to the 50 already, then started to move down again. And this is what at this point we call the O divergence is already played out. So when we're looking at the right hand side of the chart, we just compare the most recent lows of the chart. If the most recent lows is converged, then we are telling that right now the price is still converged to the downside because the O divergence has been played out because the price already pulling back into the 50 period moving average. This looks like a little bit advanced or maybe a little bit complex, but if you look at, I highly suggest you go back to check your chart by yourself, because to see is to believe. Go back to look for the examples of divergence of the chart to see if it pulls back to the 50 more often than not, because this is what we get summarized in our trading. We know this is what happen more often than not. Exactly why the price is pulling back into 50. The main reason is, suppose this is a 15-minute chart. If the price pulling back into the 50 period moving average on the 15-minute chart, it is equivalent to the 10 period moving average of the 60-minute chart, right? Because 50 to 60 is 4 times. So 10 to 50 is roughly also 4 times ratio. So this is exactly telling us it is a pullback on the high time frame. So if you are checking on the high time frame of the 60-minute chart, the 60-minute chart should pulling back into the sell zone between 10 and 20 if the divergence happening on the 15-minute chart. So I hope you understand this concept. A little bit advanced here, or maybe a little bit complicated. Don't understand it, that's fine. You just need to remember, for convergence and divergence, we look at the most recent lows of the chart or most recent highs of the chart, and that will be fine for us. Okay, so another questions. So there's a pullback, but still there's a convergence after that for a short. Is that correct? Yes, correct. Which telling us the pullback already played out of the old divergence, and now the most recent two lows still converge, which telling us the downtrend is still strong to the downside. So we are still confident to look for short trade to the downside. It doesn't mean that we short right now, okay? Remember, one ingredient alone is not a complete trading strategy. Okay, any more questions about convergence and divergence before we go into the break? Okay, maybe let's go into a 10 minutes break now. So if you do have any questions, please type in the Q&A box. And I will put up a countdown timer on the chart, and then you can see when we will start again. Okay, let's get back to tonight's webinar. So in summary, we just finished the convergence and divergence part. Hopefully you already get a understanding of how we are going to measure the strength of the trend using these two indicators. Now we started to look at the last ingredients of our trading strategy, the multiple time frame analysis. So first, what exactly is multiple time frame analysis? First, what we define the chart we take the trade from, it is what we call the precision chart, also what we call the trigger chart. As a minimum for our trade, we need to refer to next high time frame for confirmation. What exactly is confirmation is what we are looking for: same trend and same convergence of the chart. And this confirmation chart we call the precision chart 1 or the P1 chart. And after that, we need to continue to check the high time frame up to daily, even weekly chart, mainly looking for reasons not to take the trade. Because when we are trading, we are so easy to look for reason to confirm our trade. This is the human tendency of our human nature. But what we also need to do is look for a reason not to take the trade, such as the major support resistance on the way to target, especially from a high time frame. This is really, really important. And just an example here, if we are checking, normally we are trading from a 15-minute chart, 1-hour chart, and we need to check at least a 2-hour, 4-hour chart, and 8-hour chart up to daily, looking for trend convergence, looking for trend in agreement, looking for major support resistance chart on the chart. And monthly chart, this is a special warning here. Monthly chart on Owenda's platform, FX Trade platform, is not available on the FX Trade platform, but we Owenda also offer the MT4 platform. If you really like to check the monthly chart support resistance, and you can always refer to the MT4 platform to do that. So this is really convenient actually. So this is by definition, what is a precision chart and what is a precision chart 1. So as we can see from the ratio, actually from 1 to 2 is 2, 2 to 5 is roughly 2. So on the lower time frame, the ratio between the confirmation chart and the trigger chart is the 2 times 2, the ratio, and up to 2 to 4, 2 to 4, 4 to 8. But from 8 to daily, it is roughly 4 times ratio already here. And from daily to weekly, this is 7, because 7, not 7, because 5 trading days a week. So it is 5 ratio. From 8 hours on, the ratio becomes 4 to 5. But on the lower time frame, the ratio is strictly locking at 2. So this is something we really need to remember as well. So always check the times 2 ratio, the high time frame, to looking for trend agreement, looking for support resistance line on the way to target. So this is something extra we can tell from this slide. Multiple time frame. Why we need to check multiple time frames? Because it is really important for us to know the big picture before we really enter the trade. And as we discussed at the beginning of the presentation, this is one of the mistakes often made by the new traders. Trading is probability stacking issue only. if the people trading from a low time frame, 15-minute chart, and also people trading the daily chart, they are all trending up, which there's a strong tendency of the whole of this currency from a low time frame to a high time frame. If they are both trending to the upside, this is showing us a strong momentum across the board. Then we will have a much higher probability of success trading from this pair, right? So multiple time frames, this is one thing we need to check agreement, looking for the momentum across multiple time frames. Second way is checking the major support resistance on our way to target. This is actually checking the obstacle between our entry point and our profit. Because if there's a major resistance ahead of our target, this is the time for us to stay out of the trade, because we are less likely to hit our target. In this way, if by only checking the high time frame alone, just one more step checking from our checklist, it will save us a lot of unnecessary loss. That is why we need to check multiple time frames. It is really important here. Okay, so why we need to check multiple time frames is giving us additional evidence of the strength of the trend as well. If the trend have been agreement more than one time frame, then we will build our trading probabilities. So this is also let's check the chart straight away. That's things much more easier. Okay, so this is a practical. First showing you 3 charts, because we spend more time on the charts is better, I believe. So first looking at this high time frame chart first. On the left is a weekly chart, in the middle is the daily chart. On the right hand side is the 480 chart, which is the 8-hour chart. So all these 3 time frames, they are all in agreement, which means they are all in a strong uptrending condition right now. So when we're seeing this chart, suppose these 3 charts are both from one currency pair. Now, if we are checking the same currency pair from a lower time frame, this is the 1-hour chart. What do you see from this chart? Do you see this chart is in an uptrend, or do you see this chart in a downtrend? How we can benefit from this chart? What might be the potential action you may take if you see this chart? So just briefly type your answer in the Q&A box, because from now on we are going to get into more and more this kind of real life example, and we may spend a little bit more time on this chart from now on, because a lot more practical is coming in right now. Okay, someone say buy on a drawback. Drawback to where? Where is your point? Where is the point for you to looking for a buy? So yeah, give you another 10 seconds. If you do have any idea, just type in the Q&A box. Between 10 and 20 moving average buy zone. Okay, have to see 4-hour chart or daily to see confirmation. We already showed you the weekly, daily, and 8-hour chart just now. So wait for the downtrend. Someone say wait for the downtrend. Okay, so just make things clear first. This chart is coming from this 3 chart. This 3 chart is the same currency pair, weekly, daily, and 8-hour. Now, this chart is from the same currency pair, but showing the 60-minute chart at the same time. So just make things clear. So when we're seeing this time frame, so for trading, because my experience telling me for trading, we need to come up with at least 2 or 3 scenarios in our mind to tell what might be the possible scenario the chart may develop in the future. So in this when I'm seeing this 60-minute chart or this 1 hour chart, and also I already checked the high time frame. What does the high time frame telling me first? The high time frame telling me that the trend is still strongly to the upside. So this is one important indication to me is if I'm going to trade this pair, I will trade on the long side, not on the short side, because the high time frame momentum is still strongly to the upside. So this is really important. Number one thing why we discuss trend first is the direction of the trade. You need to get a clear understanding which side are you going to trade, long side or short side, or no trade. This is really important because high time frame telling us momentum is still strongly up, so I mainly look for long trade from this pair. Second, we need to determine where is the play field, or where is the potential price level I'm looking to trade to the long side of this pair. So from this chart, looks like a potential change of trend, right? Because the high is here, this high is here, the low is here. So it is a potential low high on the chart, right? Yeah, this is correct. But does that mean I'm going to short right now? No, because the high time frame is still strongly up. So instead of shorting it right now, I waiting for the price to coming back down. So just like some people say in the Q&A box, you can see this is a local support, right? One text, second text, three texts. If the price coming back down here, I'm looking for price reason to get long from this support level. Possibly some rejection candle or something else from this time frame. What I'm looking for is when the price coming down here, I will check even lower time frame for like 15-minute chart, even down to 5-minute chart. Look for the trend to reverse to upside first on this 2 time frame. Then I started to look for opportunity to get long. So this is something also what coming up to the multiple time frame analyst again, because the high time frame is trending up. So if I want to get long, I want to see the lower time frame also going up as well. So this is number one scenario. If the price coming back down to test the old support line here and found support, started to reverse back up, I started to look for a long trade somewhere from here, potentially from the 15-minute chart or 5-minute chart. This is the number one scenario. Second scenario is because maybe the price is not coming down, right? Because the trend is still strongly up. So what is the potential scenario? Number two is the price continue to move on up, right? Where I'm going to look for long trade is somewhere around here, because on the top we can see this is one text, second text, third text. On the top there's an old resistance right here. So what might be the potential scenario? Number two is price approaching to this old resistance and started to consolidate before the old resistance here, and then potentially I will look for a break up or a momentum breakout of this chart. This is second scenario, a potential breakout trade from the old resistance. Number three scenario is if the price coming up to this resistance, instead of a consolidation, it just shoot through of this old resistance. This is something really normal because we know the high time frame is still strongly up. So this is just maybe just a lower time frame pullback and then a continue upward to the upside. So maybe it's not consolidating here and shoot through. And then after that, I'm looking for a pullback to retesting the old support, old resistance line, and then after the break, now here it should become a really strong support. So this is number three scenario. I'm trying to get on board on the long side. Actually, what already discussed here is the number 3 scenario. It is what we call a potential trend flow strategy. So by that time, if the price of this moving average on this time frame also catching up with a small bullish candle just sitting above this old support line, that will be a really great potential trend flow strategy setting up to the long side. So actually 3 scenarios I will discuss from this chart. 2 are from the top, 1 are from the bottom. But no matter what, where I'm looking to trade. Number 1, I'm looking to trade with the higher time frame trend. Number 2, I'm looking for trade with the strategy according to our strategy. Like here, if the chart consolidate here, look for the breakout. If the breakout happen first, look for the pullback with the trend flow. So always stick to the strategy. This is the key to trading success. And this is also the 3 possible scenarios I can come up with from the chart. And also these are the only 3 scenarios I will trade if the chart develop further as what I'm expecting. Of course, this is just my thinking of the potential development, but it doesn't mean the chart will move in the way I'm expecting, right? So what I'm going to do if the chart is not behaving as what I'm expecting, and then I'm just doing nothing, because trading is just like going for hunting. We just need to make sure, not 100% sure, but at least 80% or 85% sure we are going to kill, and then we will shoot. But if the chart is not behaving of what we are expecting to do, and then we just sit and wait for the chart to develop further until the chart develop into a case that fits all our trading criteria. Okay, so this is something extra. So there's some experience I share with you from this chart. Okay, so this is a practical, really helpful practical. How we are going to use multiple time frame analysis based on the high time frame trend, based on the lower time frame trend, based on the high time frame, based on the lower time frame support resistance line, based on the long-term, short-term trend, etc., etc. So there's a lot of story on this chart, and hopefully you start to get some feeling of the complex of multiple time frame analysis. But looks like at first place is difficult, but just doing more practice. Practice makes perfect, right? Okay. Second practice. Some questions for you here. We show 2 charts. One is precision chart. Second chart is precision chart 1, which means left hand side is the trigger chart, right hand side is the confirmation chart. Now, question is this an acceptable time for you to buy? If yes, why? Or what would you like to see more before you make decision? And the information here we can tell is both chart, they also trending nicely, strongly to the upward. Both chart, the price back in the moving average buy zone, right? So what else would you like to see before you would make your decision to trade to the long side or not? Please type in the Q&A box to see if you started to get the understanding of the of what might comes up from our trading strategy. Okay, give you some 10 seconds to think about it. What else you might need to see before you make your decision whether to take this trade or not. Okay, someone say like to see bullish candle close above the high of previous candle. Indicators convergent. Okay, yep, this is correct. Okay, let's go through this chart together. Not exactly. This is we are telling it's a good time to buy right now. So actually, this candle is already completed. So both candle in the buy zone. Remember, on the moving average from part 2 of last week, we discussed the moving average pattern. We like to see a small bullish candle in the buy zone as a trigger candle. Okay, so this is already good enough. This is really close in the buy zone. This is already in the buy zone. We don't need to see a close above this candle sign. This is too late. Otherwise, if the close above this candle sign, this trigger candle will become too big. Big candle is not the trigger candle. We would like to get in at a small candle. Okay. So what else do we need to see? We need to check convergence, right? We need to check indicators convergence on the both chart. If they both converge to the upside, they add to our probability, right? And let me see some other answers. I would like to buy moving average fanning out. I would like to see bullish pattern on lower time frame. Actually, this is for trading. We just need to check the trigger chart. This is P chart. This is what we call the trigger chart. And this is P1 chart. It is one time frame higher. So for example, this is a 50-minute chart. This should be the 60-minute chart or 30-minute chart. So we are checking upward, but not downward. Okay. So for multiple time frame confirmation, we always check the time frame higher, but not the time frame lower. Okay. So these two charts, if we can see the convergence on the indicators, that will add to our probability. One important issue, or one single important essential factor we need to check, is someone already typing here, is there any major support resistance on our way to target? So for example, suppose we get in here with a stop here. First target is somewhere here, second target somewhere around here. Based on these two charts on the left-hand side, there's no major support resistance. But it doesn't mean that on the higher time frame, there's no support resistance. That's why we need to check the P2 chart, we need to check the P3 chart, mainly up to the daily, to see if anything that is major on the left-hand side of the chart is stopping the price to continue to move on up to hit our target. If there is a major resistance level on the chart on the high time frame, we are not going to take this trade. But based on right now, the situation telling me is there's no major resistance on the left hand side. So based on the current information we get, it is a time to buy. So this is something else we need to get to check from the high time frame. Okay, so let me check the question. Why do we need to check higher time frame but not lower? Because we look for confirmation. Confirmation is the high time frame is always more important than the lower time frame. The reason is those big traders, big institutions, they are profit from mainly high time frames because their position is so large. We are not like a retail trader. We get in, get out. Our position is not going to affect the market at all. But those big institutions, their position is so large. If they initiate their position all at once, they will have a big effort, a big effect on the market. So they don't want to do that. They want to get in little bit by little bit by little bit. So they develop their position over time and over time. They need a long time to develop their overall position, and then they need to if they want to get rid of their position, they need time to get rid of that as well. So that's why they not mainly, but mostly they trade on some high time frame to develop their position. So we are not institution clients, we are just retail clients. What we are trying to do is trying to understanding what those big guys are doing from the chart, right? So the big guys mainly focus on the high time frames. That's why the high time frames has more value, or most importantly, than the lower time frame, especially the support resistance. For example, if we can check, or maybe you just use the last example, it's better. Go back and check the monthly chart of GBP USD, the cable chart, the British pound against US dollar monthly chart. Check the 1.7 level on a monthly chart. Check back the history back into the 1990s. You will know the 1.7 is really a big level. But 1.7 on the lower time frame right now, like even down to the daily, you can't see anything at all. You don't know 1.7, the importance of 1.7 only when you're checking up to the monthly chart, and then you can know 1.7 is so important to the GBP USD. That's why we always check the high time frame, not the lower time frame, because those important information, if you don't check the high time frame, you can't get it. Okay, I hope I understand answer your questions. Okay, so this chart, back to this slide. This chart is an acceptable time to buy if we can check the indicator, converge, and also check the there's no major support resistance on the way to target. Okay, next practical question for you. Is this flat level worth trading for a breakup? What other information you would like to see before you make up your mind? So just have a look here. Type your answers in the Q&A box. Just telling me, based on your feeling or based on the knowledge you know up to today, is this a flat level deserve to trade as a breakup to the upside? Okay, someone say look at the high time frame to for a potential breakup. High time frame concurrence and indicator supporting long trade convergence. No major research into the upside. Okay, wait for more confirmation. What do you mean by wait for more confirmation? So first, based on this chart, checking the trend just step by step. First, number one case is check the trend. You can see on the left hand side, original trends to the upside, and then here we can see the lows is getting higher, right? So actually, the momentum is building up below this resistance line. But this resistance line, there's some problems. There's a blip here. There's another blip here. So the flat level is not perfect. And now we can't see the break, and we can't see the convergence. So based on this chart, we also would like to see more as the indicator. Is it converge on the trend? First converge. Is it converge on the breakup? It's here. So this is two things we need to check. This is the MACD potential RSI, something like this as well. If they are these two are flat and converge on the trend, converge on the breakup, and that will be acceptable. Just because this two blip here is not going to stop me from taking this trade. And also we need to check the high time frame. Okay, so let's bring the next slide for you. The high time frames, it looks like this. So what is your decision right now? Are you going to take this trade, or is this an acceptable time to buy right now if you see the high time frame? P1 is the confirmation chart 1, P2 of confirmation chart 2. Okay, someone say overstand it, not taking the trade. Someone say take the trade. Looks like more resistance being encountered. Yes, correct. Okay, let's check what we see on this two chart. First, we can see this is overextension a little bit. This is majorly overextension from this chart already. And then because the flat level plus the flat level on the original chart, the trigger chart is not perfect enough. So these two chart, because of the overextension, makes me thinking this is not a good time to buy the trade anymore, because the resistance getting more and more here. You're right. The PV already said P1 looks like hitting heavy resistance. Yes, correct. Because the flat level is not perfect, plus the overextension on the high time frame, and this is not the good time to buy this chart. Okay. Next practical. So in hindsight, how many trading opportunities so far we can see in this section? On the top is the P chart, on the bottom is P1 chart. So let me go through it with you. So because in hindsight, I'm not going to discuss too much in hindsight. This is something I really hate to see here, because hindsight this is something already happened. No matter what you say, the chart is already there. You tell whatever you like. But when we're looking at live chart, which is the right hand side of the chart, this is all the most important place for us. That's why all the chart we show to you just now, they are all live screenshot of the chart, making you as you are seeing a live chart right now. And then what is your decision? So in hindsight, I quickly go through it. Where is the potential trading opportunity? This is mainly talking about the trend flow strategy. Mainly looking for a small bullish candle in the buy zone, somewhere around here, somewhere around here, right? Somewhere around here, a lot of here. So if you are clicking on this chart, somewhere around here, 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 a lot of here. This is also both a small bullish candle in the buy zone. Okay. This is a silly question, I think. Would you buying here right now? I think most of you will get the answer correctly. No, because the chart, the move already happened here. We can see compared to this bunch of candles, this is a really big candles. The move is already underway. We are not chasing the market. Hopefully, when you finish today, and you know at least we as a professional trader do not chase the market. This is not professionals. What professionals doing? These are all amateurs doing. Just wait. If we miss this point, miss the entry, just wait and look for another trade. Okay. So actually, why we are looking for multiple time frame analysts? Can we look for the trend, the major trend and the minor trend from the same chart? Yes, we can. Just like here. On the chart, there's some major highs and major lows. And within these highs and within these lows, there's some major minor lows and minor highs here. So if we can look for these minor trends and major trends when they are all in agreement, that is the time for us to look for a short from the chart, because that is the time the trend has the much better position for a trade setup. So this is something we can get from one chart. This is something we can get the same information over multiple time frame as well. The main reason looking for multiple time frame is something we can't get from one single chart is a major support resistance. Just the example I talked to you just now, the GBP USD 1.7 level. No matter how you zoom in the daily chart, you can't see the 1.7 level, the importance of 1.7. Only when you're checking the monthly chart, you will see that. So highly suggest you go back and check the GBP USD chart today. Really, really powerful level of 1.7 on the monthly. Okay, so this is what we discussed up to today of the multiple time frame analysis. The main reason is we look for trend agreement across multiple time frames. So putting it all together, the recipe for the strategy. So today, some practicals first. In hindsight, do you see any trading opportunity? Do you see any flat level breaks up? Are they converge or not? So start with a hindsight. We can see there's 3 flat level right here, right? Are they converge? Let's check. Easy. Sorry, this is in hindsight chart, so let me go through quickly. First breakdown, we can see the breakdown is here. Breakdown is flat right here. The breakdown is happening is flat. This is a little bit diverged, right, on the MACD. So this is flat. RSI is flat. This is MACD is a little bit diverged. So these two cancel out each other. This is a acceptable entry here. Second, we can tell here flat, draw down here, here, here. Same thing as the first one. RSI is flat, MACD is diverged, so this cross out each other, so this is still acceptable. Number 3 is here. Number 3 is the best one, I think. This MACD started to get flat, RSI flat. So number 3 is the best case scenario for trading a breakdown. This is a breakout strategy. Are they converged? Yeah, some of them, some are not. Any trend flow strategy, mainly looking for a small bearish candle in the sell zone, something like here, something like here, a lot, something like here, small bearish candle in the sell zone. This is all in hindsight, so that's why I'm not going to spend any more time on this chart, because this whole hindsight. And let's check another chart, another practical. This is all live chart. Now we can spend more time here. Okay, 3 charts for you to consider. They are all from the same currency pair. Trigger chart on the left, confirmation chart 1 on the middle, confirmation chart 2 on the right. What is good about this trade? Or maybe I should ask in this way. Is it a good time to buy right now? Just type yes or no from the in the Q&A box to see. Let me see if you get some understanding right now. Okay, someone say no. No, no, no. Okay, a lot of people saying no. Okay. Okay, so actually this is a really good setup for you to think about it. First, trigger chart, P chart. You can see this momentum strongly push up, right? So on the left hand side, this original trend still to the upside. Checking the lows, always start to check the trend first, no matter what. Check before checking anything else, check the trend. The lows is getting higher because you can see the buying momentum coming up. On the top, there's a flat level here, right? One text, second text, third text, looking for trading the break up of this flat level, right? So trigger chart, there's a potential breakout strategy. Breakout is happening right now. So am I going to take this one? Well, I need to check from this chart alone. Trigger chart, need to check. First, check the convergence. 2 things. Convergence of the trend. Is it convergence of the trend? Price making new highs, indicators making new high. Convergence of the trend. Is it convergence of the break? Convergence on the break or not? Yes, convergence on the break, right? If the price breaks up right now, indicator is going to break up right now, right? So convergence on the trend, convergence on the break. Tick, tick, tick. Trend is all fit here. So trigger chart fits all the criteria. Then going to the confirmation chart. Confirmation chart mainly looking for trend agreement, right? Trend agreement, trend agreement. Someone say if you check the flat level here, yes, RSI is flat. This is MACD is strongly diverged to downside. Yes, that's fine because these two just cancel out each other. So P1 chart, there's a mixed information here. Some telling me the break might not converge, but the main important thing is coming from the P2 chart. The confirmation chart, maybe this is a 15-minute chart, maybe probably a 60-minute chart, maybe probably a 240-minute chart. So I don't know. There's no information here. So mainly of this time frame. First, the trend is really strong to the upside, right? Even most recent highs, the trend is also converged to the upside, and also really close to the moving average. Is not overextension from the moving average. Remember the previous example, previous practical. This is getting really close to the moving average. Everything points to the upside. So for trading, we just need to list the reason to trade and the reason not to trade. From this 3 chart, we have a lot of reason for us to taking this trade, right? We have only one reason here telling us not to take this trade. So the odds is in our favor because we have lots of reasons supporting our entry for a long trade to trade the breakout. And plus, if we check based on these 3 time frames alone, on the left-hand side, we can't see any major resistance on the left-hand side of the chart. So I assume there's no major resistance on the left-hand side. So this telling me this is a really good trade, actually looking for a trading breakout. So if you still don't quite get it, no problem. You have a clean or clear checklist for both strategy from next week. So bear in mind, this is a really classic example of a breakout strategy. So that's why we call what is good about this trade. This is already telling you this is a good trade actually. Okay, no problem. Next chart. Is this a good trade setup right now? Are you going to take this trade? What is good about this trade? Same thing. Let's go through it together. Trigger chart. Check the trend first. Trend making lower high, making lower low. Flat level, one text, second text, third text. Okay, so trend is down, flat level is here. Trend is it converge, checking the lows, because downtrend, remember, checking the lows, convergence. Checking the breakout, is it converge on the breakout? RSI a little bit diverge, yes, a little bit. This is also a little bit diverge. But when we are checking on the high time frame, the P1 chart is actually, the P1 chart is flat. So which tells us this should be, I believe this is not the trigger chart. This should be the trigger chart. So based on this chart, trend is also converge. Indicator flat to converge to break to the downside. That's why it fits all the criteria. Also on the left hand side, I can see any major support on the left hand side. So that's why what we call this is a good trade setting up right now to trade the breakdown. Okay, let's check. So in summary, today we already learned two more trade technical ingredients that can potentially increase our trading success. One is the convergence and divergence. One is the multiple time frame analysis. This is all just adding to our trading strategy, the recipe. Now, just trading, no matter you are talking about trading strategy or you are talking about trading itself, is it an art or science? Sometimes it's a science, sometimes it's an art. But for teaching purpose, we need to make our trading strategy as clear as possible and as scientific as possible, because we really need to give you something for you can follow exactly. But how individual apply this trading strategy, it is an art, because the trading strategy is there. Different people may have different effect on the strategy. How individual implement the trading strategy really affect the trading performance curve of herself or himself. This is also comes to the part of an art. So no matter how good the trading strategy is, there's one more thing we need to tell you is the risk management, because risk management part is one of the important ingredient in the whole trading plan. So today we are going to briefly introduce you a little bit today, and we will have a detailed calculation about the risk management, how much position size, how big the position size for each trade we need to put in. We will have a detailed calculation section from next week or in part 4 of our course. Today we are just going to give you some idea why risk management is so important, because risk management is the key for every successful trader. New traders always looking for profit. When I can get a profit, when I can get a home run trade, when I can get a big runner for 3-1, 4-1, or 10-1. This is some general mistake by new traders. They fully focus entirely on the reward side, but never think about the risk side of the trade. But most of the successful trader, experienced trader, they focus on what they have first, meaning controlling their risk. Try to reduce the risk as fast as possible. Then, before they thinking about the reward, because every time we open up a trade to the market, we expose ourselves to the whole market with risk, with a lot of risk. We even have a dedicated webinar to talk about the risk from trading. So because trading forex market, trading any market is risky, especially with leverage. So if you want to make money consistently out of the market, if you trade without a prudent risk management plan, you are not going to do that. So that's why it's really important for you to understand why the risk management is so important in trading. So managing the risk, first we need to accept that every time we open a trade, we expose ourselves to the market. Every trade will have risk of a potential loss. Then we try to avoid the risk or transfer the risk, reduce the risk, etc. from a lot of ways, either reducing your position size or either partially taking profit off the table when you see some profit, and some other like trial your stop, etc. There's all kinds of means for us to consider how to reduce the risk. And this is also the number one job for successful trader. They accept risk and try to minimize the risk impact in our own trading. So money management or risk management is actually what exactly is that? It's just a set of rules telling you how to manage your trade decision. For example, how much risk per trade I'm going to open each time? What is the maximum total risk of our trading equity I can expose to the market, etc. This is all the rule you set by yourself, and only the rule you set by yourself and follow it, and then you can have a chance to survive in the market. One important goal for trader is risk management system. Risk management system is the way helping us to reduce the emotional impact or the financial impact from ourselves or from our trading account from one single trade. We need to reduce the risk for every trade down to a level that is comfortable for us. Then we will have more room or more trading capital for our next trade. For example, if one trade we lose some 80% or 70% of our total trading capital, then possibly we will already lose our confidence, and then we will lose our game of survival in the trading. So make sure you reduce the risk down to a level that is comfortable to you. Then we will give ourselves a chance to trading success. That's why risk management is so important in trading. So this is just a brief illustration. Again, trading account is just like a wall, a brick wall, and with a metal ball hitting or crashing into the wall. The size of the ball is equivalent to the size of your risk. Yellow ball 1%, white ball 1%, yellow ball 5%, green ball 10%, black ball 25% risk. For example, if our trading strategy has an expectancy of 70%, which means we will have a 70% probability of winning, but we still can easily have 3 losing trades in a row. This is by probability grid. So let's see what may happen to our trading capital after each color ball hitting the wall. White ball 10%, not a big issue. Yellow ball like 20%, something, some holes here. Green ball hole getting almost 50%. Black ball, probably when hitting 3 times of the wall, the whole wall is not existing anymore. So the higher the risk amount of trade, the greater the chance of you losing your capital quickly. So make sure you control your risk in a way that is no matter, not no matter, but as the ball hitting one times onto the wall, it should not make a big impact of your trading capital. So a risk management plan, if we can apply it consistently with small amount of capital, that will making us a much more sense to trading success. So this is what we call money management, a illustration. For detailed explanation of the position size per trade, we will discuss much more further from next week. So for us to think about the risk management, every trader should need to think about is stop loss, where you are going to place your stop loss, potential risk reward for the trade. Money management, what is the percentage of your trading capital you are going to risk on each trade? What is the maximum total opening risk at one time you allow yourself to have? Because it's quite often that all your trades will go into stop at the same time, right? So you need to make sure the total opening risk is acceptable for you as well. So as a trader, as a professional trader or successful trader, accepting and minimizing risk as much as possible, it is the crucial part to trading success. So all this point we discussed today for risk management, we will have more detail discussed in part 4 of our forward-thinking trading. So what we are going to cover in part 4 of the course, of course, the two strategy, trend flow strategy, momentum breakout strategy, with a checklist and with more practical examples there, because that is the time for us to do more practice. Because after the course, it is you facing the live chart, not me. Everyone trading based on your computer. It is you making your final decision. So do more practice in the course. Hopefully, I can share with you my experience with you more from part 4 of our course, with a complete recipe, a complete strategy, telling you that determine exactly where is your entry point, where is your stop loss placement, how you set your target, how you manage your running trade, etc., etc. This is all what we are going to discuss in part 4 of the course. So if you do have any questions, please email frontdesk@oanda.com. And if you are still not Oanda's client, would like to join part 4 of our premium course, please register a live account at oanda.com. So if you have any questions, please type in the Q&A box right now. And also, if you have any question about Oanda or opening an account and would like to share with us, you can contact one of the phone number showing on the screen. Okay. Question: how do you decide which time frame to use as your time frame? Our strategy is applicable to any time frame and any market. It depends on your risk profile. It depends on your personality. Someone say, I don't have too much time to trade intraday because intraday requires a lot of screen time. And if you have a busy lifestyle with your family, with your friends, probably you can trade on a daily chart. You just need to check the chart once a day. If you would like to glue to your screen all day, and probably you can trade intraday. So it doesn't matter because our trading strategy can apply to any market, any time frame. Now it just depends by yourself. Okay. If you don't get feel on the trigger bar due to small inside bar or a bar that goes lower, does invalidate the trigger? Yes. If the price hit the stop level before triggers you in, the whole setup's invalidated, and then we need to wait for another setup. Okay. Okay, no problem. Yeah, I'm glad that you enjoy the session, and because we will, I'm going to be the presenter for part 4 of the course as well. So hopefully I will meet you again next week. Okay, okay. Seems there's no more questions coming in, and thanks everyone for joining tonight's section, and see you again next week. Have a good night.